Hello, my name is Philip Totaro. I'm the founder and CEO of market research firm IntelStor. Welcome to your weekly dose of truth to power. Truth to Power examines data driven insights for the energy sector with a focus on renewables. On this week's episode, we'll look at the improvement in wind energy asset profitability in the United States and the impact that the production tax credit has on those profits. Well, the United States saw an improvement in wind energy asset profitability in 2024, and that was largely due to an increase in average power purchase agreement prices. In 2023, by comparison, the US had 20.3 gigawatts of wind energy assets that were not going to break even during the lifetime of the project on the capital that was initially invested. But in 2024, that dropped dramatically to 14.36 gigawatts of projects that are still below the profitability line through the planned end of asset life. This dramatic improvement is largely due to a combination of the PPA prices, but also some slight improvements in the technical performance of wind energy in the USA. Inclusive of utility power offtake agreements, publicly filed corporate power purchase contracts, as well as merchant power prices, the average PPA price for wind energy in the United States in 2024 was just a fraction under $56 a megawatt hour. Compare that to 2023, where it was $36.76 a megawatt hour. Based on IntelStor's analysis, the industry saw an improvement from 2023 to 2024 of more than $190.9 million in net profit to wind energy asset owners through the planned end of asset life. This is also reflected in a slight reduction in the average time required for asset life extension in order to break even. Previously, in 2023, it was 7.84 years. That's now down as of 2024 to 7.28 years. The average age of assets which are unprofitable actually increased from 10.98 years in 2023 to 11.99 years in 2024. And this is reflective of new capacity coming online that has a higher technical performance, but also higher average PPA prices for projects in 2024 compared to the prior year. That's driving things up that are older. As a consequence, the time frame for full asset payback has dropped to just over 12 years. The uptick in this payback time frame that we saw back in 2020 was largely due to unsustainable power purchase prices in markets like the Southwest Power Pool, as well as out west, since many co-ops and community power buying associations and community choice aggregators were able to strike cheap deals for offtake that would allow the independent power producers to jump to the front of the queue for interconnection. Now, revenue to the wind energy asset owners from the production tax credit now tops a total of $66 billion as of the end of 2024. The impact of the production tax credits on overall revenue to asset owners has been reduced since 2023 due to rising average PPA prices. But while the final language of the tax and budget bill currently pending in the US Congress has yet to be fully determined, it's expected that the PTCs will be phased out by the end of 2028. If that happens, the wind energy industry in the US stands to lose somewhere between $12 and $16 billion in PTC revenue compared to the current tax law set forth in the Inflation Reduction Act that was passed in 2022. The reason for that wide range between 12 and 16 billion, it results from the prevailing wind conditions, since the PTC is obviously production based, as well as lack of clarity on how the PTC will actually be ramped down between the passage of the bill in 2025 when the new regulations would take effect and the end of 2028 when they would be fully phased out. Beyond this, much of the planned capacity for repowering projects stands to be largely decimated. Despite the higher than average PPA prices in the US more recently, without the benefit of the production tax credit, many projects that could have been repowered will likely either try to extend the life of the project, awaiting a more favorable administration and Congress that will restore the production tax credits, or else just wind down the project at the end of the planned lifetime. But it underscores how dependent the wind energy sector in the US has actually become on the PTC. The market average in 2024 was for 23.68% of total revenue to wind energy asset owners in the US to come from production tax credits. However, because of the weighting of PTC revenue to the first 10 years of an asset's life operations, some asset owners are just more highly dependent on PTC revenue as a percentage of their total revenue. Projects that have a higher dependence on PTC revenue as a percentage of total revenue, they also tend to show a pattern of poor performance on total net profit to an asset owner. This is mainly due to the production tax credits being used to compensate for a project that probably would not have ever been built without it, because the wind resource wouldn't justify the capacity factor that's high enough to warrant a market average PPA with zero PTC. IntelStor still anticipates interest rate reductions later this year due to an increasing likelihood of a recession. And as a result of those interest rate reductions, coupled with the PPA price stability that I noted, it's highly likely many investors who have currently been shunning wind energy and solar power investments will actually come back into the market to take advantage of the beneficial project economics demonstrated by most projects. Thank you for joining me this week. I'm Philip Totaro, and this has been your weekly dose of truth to power. Follow us on IntelStor's YouTube channel as well as your favorite audio platforms. And visit www.intelstor.com to join more than 200,000 subscribers to our renewable energy data solutions. A full analysis of the USA or any renewable energy market globally is available to subscribers. And you can register today for the next Wind Summit event in Houston this October. Visit www.windsummit.org and join hundreds of your industry colleagues from companies like NextEra, EDPR, EDF, Pattern Energy, Clearway, Apex Clean Energy, and more. We hope to see you there.